Today we have to talk about the Federal Reserve and what their plans are next month on May 3rd. Personally, it's important that you guys understand what happened in January and that's moving all of this along. Back in January, the Fed revised the formula that they made that actually determines what the CPI number is. When you guys are looking at Fox Business, CNBC, Bloomberg, that headline number, the formula that made up that number was changed to make it look like CPI was falling a lot faster than it otherwise would have been. And that's because they took out a lot of the rent inflation. And if you guys know anything about rent inflation, it's been going up every single month for over a year. It's that one thing that has decided to not come back down, along with everything else like used cars, things of that nature, regular cars. It's not coming down. Rent inflation continues to go higher and higher, which is just decimating most people out there, right? You guys know how much it costs to rent. Now, because we have this inflation that's still relatively strong, around 5%, and I know 5% doesn't seem like a lot. We're supposed to be at 2%. To the average American out there, 5% is really killing everybody out there. Now, this gives more room and more leniency for the Fed to do one more 25 basis point rate hike. They can easily do this without drawing the ire of anybody out there because, remember, we already had a banking crisis, and what happened? The Federal Reserve, the banking system, unleashed unlimited amounts of money to make sure that no matter what bank was having issues, they were going to be fully liquidated. That actually added to the balance sheet here, which was actually very inflationary, but people haven't been talking about it too much because we just want to see that the banking system is calmed down and it's not actually going crazy anymore with what we saw with Silicon Valley Bank, Silvergate Bank, and Signature Bank. Those banks that all had issues, they all fell down. That's going to give the Federal Reserve one more quarter basis point rate hike. And I believe that's going to be it for the entire cycle. But after that's announced, guys, it's going to remain to be seen whether or not the market continues to go higher, especially when the Dow Jones is just about 10% away from all-time highs. Most people that are out there in the economy, they would probably think it's a little bit weird that the Dow Jones is close to all-time highs, yet the economy still feels like shit, right? So after he does his 25 basis point rate hike, I think this will give enough time for the 75 basis point rate hikes that we had last year and the 50 basis point rate hikes to actually move their way through the economy. We haven't felt those effects fully just yet. Only the real estate markets have really felt those, and the loan credit markets, that's about it. Everybody else still hasn't actually felt that first 75 basis point rate hike, which might blow some of you guys' minds. This is why the Federal Reserve is actually putting out formally now that they think there's going to be a recession. After months and months and months of saying, hey, there's no recession coming, the data does not support a recession, la-di-da, all of a sudden they're saying, hey, we see a recession incoming. And most people out there on YouTube, Twitter, TikTok, everybody's been calling for a recession forever. Even the guests on this CNBC's and Fox Businesses, they've all been calling for a recession. But the overall market has ignored that because there's been so much new money that was propped up during COVID in the economy. All that money doesn't like to sit on the sidelines. People want to get that money working for them. So while the treasuries are going higher, while everything is going smooth, people can put the money wherever they want to because there's just so much money in the system. And that money is not going anywhere, which is why inflation has been so sticky so far and why we just can't get back down to that 2%. As of now, the Federal Reserve expects us to get to that 2% rate sometime in 2024 or 2025, okay? That means we might have this high interest rate environment for a while, and even if we do go into a recession, that's not going to be enough for Jerome Powell to actually want to lower rates. But here's where the disconnect comes from many people like me on YouTube or TikTok, and what you might see from the people at CNBC. People like me, we're pricing in a strong Jerome Powell who is resilient and who will not lower rates just because he's told to by whatever president's in office, whatever Treasury Secretary is out there. We don't think he's going to bow to that pressure because he's going to want to focus on bringing inflation all the way down to 2%. The stock market, the hedge funds, all those people, they're all pricing in Jerome Powell actually being very weak in this department. And by weak, as soon as there's a hint of a recession, he's going to start cutting rates, even if that means that inflation will go up. Because the recession is a very deflationary event already, but because we're going to have to deal with this, and the Fed's going to have to deal with this, we're having this tick-tock pull battle here to try to determine who's going to be more correct. Is it going to be the Federal Reserve that's a weak, or is it going to be the Federal Reserve that's much stronger? And that's what we're going to have to wait for. But I do believe this month is going to be the last rate hike of the entire cycle.